Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 and the QQQs for the week ending Friday, December 30th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. This is going to be a very, very special video for you, so if you like making money and hate losing money, make sure you watch this entire video. So to start off with, let's start off with the S&P 500, and then we'll move over to the QQQs here in a couple of minutes. This is a weekly candlestick chart of the S&P 500 that is 2 years and 2 months long, so it reaches back into the latter part of 2020. The green line is the 40-week moving average. And this horizontal blue line, this denotes a bear market, and we'll come back to that here in just a couple of minutes. But to start off with, the S&P 500 for the final week of 2022 was down 14 basis points, so not a lot of movement from point to point, but intra-week, right? There was a lot of intra-week volatility, but we finished down just 14 basis points for the week. And for calendar year 2022, the S&P 500 was down 19.44%. Now, from the all-time intraday high, which was set on January 4th of this last year at 48.1862, so from that starting point to where we finished at 38.3950 on the 30th of December, that puts the S&P 500 barely by 32/100ths of 1% in a bear market. The S&P 500 did finish down 20.32% from its all-time intraday high. So that's this line here is that bear market. So anything below 38.54.89, that line is 20% below the 48.1862 all-time intraday high. So anything below this line in the S&P 500 is in a bear market. And what I can tell you is, I mean, this was a tough year, don't get me wrong, guys, but on the S&P 500, we want to be technically accurate, right? We can't be emotional. We want to suppress our emotions, and we want data. We want accuracy in our work. And so what I can tell you is the S&P 500 only, right, I think it felt worse than this, but the S&P 500 only finished in bear market territory 11 weeks on a weekly closing basis during calendar year 2022. And, of course, the last 3 weeks, we barely, but the last 3 weeks of the calendar year, we did technically finish in a bear market because we closed below that 38.54.89 level. Not by a lot, but just a little bit right there, okay? The lowest point so far in this downturn was achieved on October 13th at 34.9158 right here. And then, of course, we had that intraday reversal, and that set up a 10-week counter-trend rally that peaked at 4,100.51, and then we got rejected there and at this downtrend line, right, which connects the wicks of the candles. And you can see, I mean, clearly, right, you can see we just keep touching and maybe barely exceeding these levels. But we've been consistently, since the 48.1862 all-time intraday high on January 4th, we've been consistently rejected at this downtrend line. You know, and where we're trading at right now, guys, we're trading at levels that we first achieved back in Q1 of 2021. So I kind of circled that area here. So we literally have round tripped, right? And we just, you know, we haven't made any progress now for 2 years, right, since the tail end of 2020, beginning of 2021. Is it possible that the worst is behind us and that this 34.9158 level becomes the ultimate low for the S&P 500 during this bear market? It's possible, but I think a more likely scenario is that we undercut these lows somewhere in the first 3 to 6 months of 2023 before this is over. All right. I'm not trying to make any predictions, but just mathematically, and also if you look at the last two major bear markets, 2003, 07, 09, which, by the way, I've got another video that I produced clear back in February of last year, guys, called How Low Will The S&P 500 Go? So if you haven't watched it, keep in mind I produced that almost a year ago, and you're going to see how accurate that information has been so far. Again, that video is called How Low Will The S&P 500 Go? So after you get done with this, make sure you watch this entire video. But if you're so inclined, go back and watch that video. But just understand that it's 11 months old or so, 10 and a half, 11 months old at this point. But you'll see potentially how low the S&P 500 could go from a technical standpoint. All right, and I went back and compared the and looked at the the last two major bear markets and how far they fell. So I would encourage you to watch that video if you haven't seen it or haven't seen it for quite a while. All right, but right now barely in a bear market. But there's still a lot of things that are going against us from an economic standpoint, and technically, it just doesn't look like this downturn is over. Now let's turn our attention to the triple Qs. The triple Q, of course, is an ETF that tracks the Nasdaq 100, a very high beta hot area, tech-heavy area. And guys, even if you predominantly invest in the S&P 500, it's good for you to understand this. And like I said, I've got a lot of really good information for you, even a lot of stuff after this chart. So please watch this entire video for your own benefit. Trust me, a lot of good information here. All right. Now, the triple Qs down 40 basis points this last week. So again, not a ton of movement, but triple Qs were down 32.58% for calendar year 2022. The triple Qs peaked back in November, and then kind of did some chopping sideways. So, really didn't start to roll over until the S&P 500 did in January, but technically peaked back in November at 405.20. So that is right now the top tick on the triple Qs. The triple Qs are down 33.54% from their all-time intraday high. So where we closed on Friday, December 30th, 2022, is 33.54% from that all-time high, and not too far off of the lows. Again, we closed at 266.28, and we've hit a low so far back in October of 253.65 on the Qs. But what's this I find so interesting. Look at this 260 line, and look at how this has been a multi-year support level. And I did point out here because I knew somebody was probably going to challenge me, but look at this. We closed back here in October this week where my cursor is moving at 260.12. But guys, we have not, and I want you to understand this because this is so important, okay? So don't miss this point. We have not had a weekly close on the triple Qs below 260. Let's move to the left. Had some intra-week trading. I want to be technically accurate here, but remember closes, right? Weekly closes are more important than intra-week trading. But we have not closed on the triple Qs below 260 since clear back here in July of 2020. All right, so that makes on a weekly basis, we haven't had a weekly close on the triple Qs below 260 since July of 2020. So that makes that a very, very important level. And you can see how we come down and just kind of kiss this area, maybe trade below it intra-week. But look at this. We have not had a weekly close since July of 2020 below that 260 level. So we really need to keep, for any of us that use the triple Qs, from a technical support level, guys, we really, really want to watch this 260 level, because if we start to see, weekly closes below that 260 level, knowing that it's been about 2.5 years, right, since we've done that, since we've closed below 260 on the Qs on a weekly basis, we know that we've got some problems, okay? And I think that that's a very likely scenario, but that gives you a real important level to watch. And on the top side, 295. Look at how this 295 level has been a very important support and resistance level going clear back to 2020, right? November or so, October, November, we kind of kept kissing this area even back into August, but we couldn't close above it until right here, latter part of November in 2020, we finally got above it and then pulled back to it in May of this last year. And we've, and it's acted overhead resistance right here in June, and then support for a couple weeks here, finally got below it. And then we have not had a weekly close on the Qs above the 295 overhead resistance line since September of this year, right? We came right up to it and had some intra-week, right? 295.04, you can see it right there. And then a little bit of trading 3 weeks ago above it, but no weekly closes above 295 since back in September of 2022. So this gives you a range of 260 to 295 to really watch on the Qs. And guys, we haven't had a weekly close above the 40-week moving average on the Qs since back in January, right? We've traded up to it and keep getting rejected. And this last counter trend rally it petered out before we even got to the 40-week moving average on the Qs, where the S&P 500 did make it up For 1 week, we closed above the 40-week moving average and got to that downtrend line, right? And then we got rejected. But the triple Qs didn't even have enough juice, enough oomph to get up to its downward trending 40-week moving average on this last counter trend rally. And we're trading, pretty darn close to the lows. And again, we're, just setting barely above that 260 level, guys. So we really have to watch that on the triple Qs over the next couple of weeks. Now let's review the performance for a few popular investments for calendar year 2022. And what we can see here is that Apple during 2022 was down 26.31%. Amazon was down 49.50%. Disney down 43.91% for calendar year 2022. Ford was down 42.18%. Google down 39.09%. Meta, formerly known as Facebook, down 64.22%, guys. Now, let me stop here for a second and remind you that if you lose 33% on something, it takes a 50% return to get back to where you started. If you lose 50% in something, it takes 100% return. If you lose half of your money, if you start off with $100 and you lose 50 of it, you now have to make a 100% return on the $50 you have left to get back to your break even, right? To get back to where you started. So the reason I'm reviewing this, guys, it may seem basic, but I don't think most people really understand this, and this is why it's so important to not let these types of losses pile up, all right? Microsoft down 38.02%. Netflix down 51.05%. Peloton, look at this, down 77.80%, guys. And this, you look at these types of things, maybe they will come back, maybe they won't. But how long is it going to take you to get your money back in these types of things, guys? You can't let these types of losses happen, and it just, anyway, it can be devastating. We'll talk a little bit more about that here over the next few minutes, so stay with me. PayPal down 62.23%. Look at this, the triple Qs. Now, not as bad as a lot of these things, right? But the triple Qs down 32.58% for the year. The SPYG, which is another popular ETF, threw that in there. That is a growth-oriented ETF. It tracks the S&P 500 Growth Index. It was down 29.41%, so about the same, just a little bit less than the triple Qs. The Pro Shares Ultra Triple Q levered product, the TQQQ, right? Triple Qs, the triple levered triple Qs, put it that way, down 79.09%. Now, guys, the reason I put this in there is I literally have had conversation with people that they were bragging, I just buy it and hold it. Well, that's ridiculous, man. You cannot buy and hold the T triple Qs in a market like this. And again, stay with me here because we're going to talk about a way where you can know and have a market-based system to help guide your decisions as to when to trim some of your losses here. Okay, so stay with me. But the T triple Q down 79.09%, and Tesla down 65.03% for calendar year 2022. So just a few investments, but we can see, guys, this has been a bad year for sure, and it's been a really bad year for a lot of the high beta tech type products. And there's probably, realistically, there's probably more downside across the entire market for at least the first 3 or 4 months, if not longer, during calendar year 2023. Now let me share with you a few pointers for success when it comes to being in the stock market, trading, and investing. First off, remove emotion from trading and investing decisions, guys. This, it's easy to say, but it's really, really hard to do, okay? And don't fall in love with any position. It doesn't matter what it is. Well, my favorite stock, or I made a bunch of money in this, in this thing, or whatever, right? All stocks go down at some point, right? Stocks just don't go to the moon. Stocks will go up, and then, even the best stocks will pull back a lot during a bear market, like, in a downtrend like we saw during calendar year 2022, all right? So don't fall in love with any position. Learn to cut your losses quickly and keep losses small. Remember, if you lose 10% on something, it takes 11.11% to get back to break even. If you lose 20, it takes 25. If you lose 33%, it takes 50. If you lose 50% of your money in something, you now have to make back 100% to get back to where you were before, right? You start with $100, you lose 50 of it. Now you've got $50 left. If you want to get back to the $100 mark that you had before, you have to double your $50. You have to make 100% on your $50 left to get back to that $100 mark. Okay, so this is, most people don't focus enough on risk management and keeping losses as small as possible. That is really one of the most important disciplines to learn as a trader, an investor, and as a money manager. And remember, bonds don't always protect equities from losses, right? So any of you, whether it's your 401k, 403b, IRA, whatever, or however you're invested, if you're using a strategic asset allocation, remember that, and this year we saw it, right? High quality bonds went down with equities, and in some cases they lost as much or about as much as the equities did, right? So just remember, bonds are not a guaranteed safety valve, all right? They don't always protect equities from losses. And even if you do like a 60-40 type portfolio, right? A lot of people have that. Remember that, and think about this. I don't think most people think about this. A 60-40 portfolio will leave you under invested during the good times, right? The market's going up, like, let's take 2021 as a recent year, right? Market went up the entire year, a few small little pullbacks, but nothing major. It was a really good year in the stock market. If you were in a 60-40 portfolio, you only participated in 60% of the upside, right? The other 40% was in bonds. And bonds, remember, in 2021 had extremely low returns and extremely low yields. Now, in a downturn like in 2022, right, where the market fell, you participated in 60% of that, and remember, your bonds lost money too. So the 60-40 portfolio, you lost money on the 60% equity side, you lost money on the 40% bond side. So I've never been a huge fan of the 60-40 portfolio, guys, because when the market is going up, you're only participating in, part of the upside, and then when the market's going down, you're overinvested during the bad times, all right? I think there's a better way to approach this, and that is to use a market-based trend following and risk management system like the system I developed for myself. And we'll talk more about that over the next couple of minutes. Now what we're going to do is we're going to review the signals from my trend following and risk management model, my proprietary signals from January of 2022. So let's get started. So the S&P 500 hit its all-time daily closing high. Now you got to stay with me. I have to set this up, okay? So the S&P 500 hit its all-time daily closing high on January 3rd of 2022 at 4796.56. So right now, that is the all-time daily closing high on the S&P 500. The very next day, on January 4th of 2022, the S&P 500 established its current all-time intraday high at 4818.62. So the all-time daily closing high is on January 3rd, but then we made an intraday high. We went higher on January 4th, but then reversed and closed lower that day. So the all-time intraday high right now on the S&P 500 stands at 4818.62. Now, on January 14th, just 10 calendar days after the all-time intraday high on the S&P 500, the Simple Market Signals proprietary model, Simple Market Signals is my model, the very first warning came out with the S&P 500 at 4662.85. That's the very first warning from the model, right, that things were starting to turn and it looked like things might be changing. And that came out just 155.77 points. So this warning came out at 155.77 points, or 3.23% below the all-time intraday high, the top tick ever, not the closing high, but the all-time ever intraday high. So just 3.23% below that all-time intraday high, we had our first warning from my proprietary model that things were starting to change, that we may want to take some profits, that we may want to reduce some risk. And then on January 18th, the second warning from the Simple Market Signals proprietary model came out with the S&P 500 at 4577.11, 4577.11, just 241.51 points, or 5.01% below the all-time intraday high. So there's the second warning, right? Just 5%, 5.01% below the all-time intraday high. And then on January 21st, the Simple Market Signals third warning and our most dangerous signal within our model was issued with the S&P 500 at 4397.94, just 420.68 points, or 8.73% below the all-time intraday high of 4818.62. Think about that, guys. Our third warning, we had two other warnings, and then the third warning, our most dangerous signal in the model, came out with the S&P 500 less than 9% below its all-time intraday high. The rest, as they say, is history. We know that from peak to trough, the S&P 500 was down over 27.5% from its all-time intraday high to its low point so far in the downturn, and the S&P 500 finished calendar year 2022 down more than 20%. And yet, this model in January gave us three warnings, one at 3.23% below the all-time intraday high, one at 5.01% below the all-time intraday high, and then the third warning, still in January, on January 21st, guys, came out, so just 17 days, 17 calendar days after the all-time intraday high, with the S&P 500 down less than 9% from its all-time intraday high. Our model told us that things were not right. Would you like the advantage of knowing when it's generally safest and most profitable to be in equities, and when it's most dangerous and generally least profitable to be in equities? To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Want more charts? Want access to proprietary market information? Want to minimize the likelihood you will experience catastrophic losses in the market? To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com, and I will also leave a link to this site in the description box below this video.